Disclaimer: this video is created for educational and informational purposes only. It should not be taken as financial, investment, or legal advice. Always conduct your own research or consult a qualified financial professional before making decisions related to money, investments, or financial planning. Money moves the world, but sometimes it feels like it's slipping through our fingers faster than we can keep up. Welcome to Money Mindset, where we make financial ideas simple, visual, and actually fun. Today, we're diving deep into inflation, what it really is, why it happens, and why it affects your life in ways you might not even notice. Let's start with a simple observation. Think back to last year. Maybe you bought a coffee for $3, a sandwich for $5, and filled your car for $40. Fast forward to today. That coffee costs $3.50, the sandwich is $6, and gas is $50. Your paycheck might be roughly the same, but suddenly, it feels like your money doesn't go as far. That feeling is inflation. It's not just numbers on a chart. It's a quiet shift in the value of your money. At its core, inflation is the decrease in purchasing power over time. A dollar today buys less tomorrow. But it's not magic, and it's not random. Inflation has causes, consequences, and even patterns we can understand. And the surprising truth, it's all tied to human belief and psychology. Imagine money as a story we all agree to believe in. We touched on this in our last video about fiat currency. That money has value because we trust it does. Inflation is the part of the story where that trust is tested. When more money enters the system than there are goods and services to buy, prices rise. But it's not just printing money that matters. It's also expectations. If people expect prices to rise, they act differently. They buy sooner, spend faster, and demand higher wages. Shops raise prices in anticipation. Inflation becomes a self-fulfilling prophecy. Economists call this expectation-driven inflation. It's like a ripple effect. One belief spreads through the economy, affecting millions of decisions every day. History gives us powerful examples. Let's go back nearly a century. In Weimar Germany, during the 1920s, the government printed massive amounts of money to pay off debts. Prices didn't just rise. They skyrocketed. People carried wheelbarrows of cash to buy bread. A loaf that cost a few marks yesterday might cost millions today. Money hadn't changed physically. It was still paper, but the collective belief in its value had collapsed. Or look at Zimbabwe in the 2000s. Hyperinflation reached unimaginable levels. At its peak, prices doubled every 24 hours. Savings became worthless overnight. Again, the currency itself hadn't changed materially. The problem was trust. Once people stopped believing in the value of money, it ceased to function as money. Even in modern, seemingly stable economies, inflation has a profound impact. In the United States during the 1970s, inflation reached double digits. People experienced stagflation, a combination of rising prices and stagnant economic growth. Groceries, rent, gas. Everything became more expensive. Families adjusted their budgets, workers demanded higher wages, and businesses struggled to keep up. The lesson? Inflation touches every part of life, from the grocery store to the stock market. But here's a critical insight. Not all inflation is bad. A small, steady level of inflation, typically around 2% per year in developed economies, is actually a sign of a healthy, growing economy. It encourages spending and investment rather than hoarding cash. If people expect prices to stay the same or drop, they might delay purchases, slowing economic growth. This is why central banks aim for moderate inflation. It keeps the wheels turning. So, how does inflation work in practice? Imagine a simple economy. 100 people, 100 goods, and 100 units of currency. Each person can buy one good. Now imagine the government prints another 50 units of currency, but the number of goods stays the same. Suddenly, there's more money chasing the same goods. Sellers raise prices because everyone has more money, but the supply hasn't changed. Your purchasing power decreases. This is the basic mechanism of inflation. Inflation doesn't affect everyone equally. Savers, for instance, can be hurt because the money they store in a bank loses value over time. Borrowers, however, can benefit because they repay loans with money that's worth less than when they borrowed it. That's why understanding inflation isn't just about prices. It's about how it interacts with wages, savings, investments, and loans. Modern inflation is more complex because most money isn't physical. Today, money is digital. Numbers moving through banks and payment apps. Yet inflation still happens because trust and expectation still drive value. Even cryptocurrencies are vulnerable. Bitcoin, Ethereum, or other digital coins can fluctuate wildly because people's confidence in them changes. The principle is the same. Money, whether paper, digital, or crypto, depends on collective belief. Let's also consider the psychological side. Inflation affects how we make decisions. When prices rise rapidly, people spend differently. They might stock up on essentials, delay non-essential purchases, or demand higher wages. Businesses may raise prices preemptively, creating a feedback loop. Economists call this behavioral inflation. It's the human reaction that amplifies economic effects. Inflation also connects to interest rates. Central banks adjust rates to manage inflation, raise rates, and borrowing becomes more expensive, slowing spending and cooling inflation. Lower rates, and borrowing is cheap, stimulating the economy. These decisions affect mortgages, loans, credit cards, and even stock prices. Understanding inflation means understanding this delicate balancing act. So, what can you do as an individual? First, be aware that inflation is inevitable, but it doesn't have to destroy your finances. Consider strategies like investing in assets that historically outpace inflation, stocks, real estate, or certain bonds. Keep an eye on wage growth and cost of living changes. Most importantly, understand the story behind the numbers. Inflation is not just an abstract concept. It's a reflection of trust, expectations, and human behavior interacting with money. Next time your coffee costs more, your rent goes up, or your grocery bill grows, remember, it's not just economics. It's psychology, trust, and collective belief all at work. Inflation isn't magic. It's the invisible tug-of-war between money, people, and expectations. And the more we understand it, the better we can navigate it. If you found this video helpful, hit like and subscribe. Here at Money Mindset, we make financial education clear, engaging, and fun. Comment below. How has inflation affected your everyday life? This content is for educational purposes only and reflects personal opinions, not professional financial advice. Viewers should conduct independent research or consult a licensed financial advisor before making financial decisions. The creator and this channel are not responsible for any losses or actions taken based on this content.